To the average consumer, a private island is the ultimate symbol of vanity. The public looks at aerial footage of white sand beaches, glass-walled tropical villas, and deep-water docks, viewing them purely as a multi-million-dollar vacation playground for the global elite. But within the closed networks of family offices, institutional wealth management, and ultra-high net worth asset allocators, a private island is viewed through a completely different mathematical lens. It is not real estate. It is the tactical acquisition of absolute sovereign insulation. As global financial systems face unprecedented volatility, traditional asset classes like public equities, fiat currencies, and even premium mainland real estate become increasingly vulnerable to systemic risk, regulatory updates, and aggressive tracking. To counter this vulnerability, the upper tier of elite wealth allocators executes a macro strategy of physical and legal detachment. By routing liquid capital through multi-layered offshore holding companies and exclusive private placement syndicates, they purchase land masses completely decoupled from municipal grids. This is the calculated transition from a mere high-earning individual lifestyle to an independent, self-contained sovereign corporate entity, turning geographic isolation into the ultimate tax-advantaged financial moat. The structural genius of the private island playbook lies in the execution of its supply chain and infrastructure. Buying raw, unmapped land in international waters is a liability. Transforming that land into a self-sustaining asset matrix requires monumental institutional-grade engineering. When a tech billionaire or a real estate mogul acquires a private island in regions like the Bahamas, French Polynesia, or the Mediterranean, they must establish independent utility sovereignty. They deploy private maritime engineering syndicates to install deep-water desalination plants, closed-loop solar arrays, and high-frequency satellite array frameworks. The capital expenditure for this infrastructure is massive, frequently matching or exceeding the original cost of the raw land. However, this is where the private equity playbook takes effect. Every single dollar funneled into infrastructure upgrades is structured as a capital improvement through a corporate holding company. This architecture creates an ironclad tax shield. High net worth operators utilize cross-border tax-deferred exchanges and corporate depreciation write-offs to illegally erase their active income liabilities. The island ceases to be a liability or an expense. It transforms into a highly structured, depreciating asset on paper that is simultaneously appreciating in raw physical value. It becomes a silent, off-grid vault that compounds wealth in absolute privacy, far removed from standard domestic property taxes and mainland municipal oversight.